I want to ask you something, and I want you to actually think about it for a second. How customized is your investment portfolio right now? And I don't mean, does your advisor call you once a quarter? I mean, does your portfolio actually reflect your tax situation, your income timeline, your specific life? Or is it basically the same mix of funds that millions of other people your age are sitting in? If you're in your 50s or early 60s with real assets built up and real retirement decisions ahead of you, that question matters more than almost anything your advisor has probably said to you this year. Because there is a strategy that has existed for decades that high net worth investors and institutional portfolios have used quietly and effectively for a long time. And the average person 10 years from retirement almost certainly never had a real conversation about it. It's called a separately managed account. And by the end of this video, you're going to know exactly what it is, whether it applies to you, and the 5 questions you need to ask your advisor today to find out if you've been leaving serious money on the table. Stay with me. And if you're new here or you don't have an advisor, I want you to know that my name is Jacqueline Shattuck, and I'm a certified financial planner and founder of Golden Wealth Strategies. I help people like you retire every day. So go ahead and hit that subscribe button if you're getting and or staying retired is a goal for you. Before I explain what this is, I want to tell you about a client. Let's call him David. David is 58 years old. He's a senior engineer at a large tech company. He's been there 22 years. Smart guy, disciplined saver his whole career. He has a 401k with about $600,000 in it and a brokerage account with another $400,000 in it, and a chunk of company stock that he's accumulated through years of equity grants worth somewhere around $280,000 as of today's price. On paper, David looks great. He's done everything right. But here's what's actually happening. David's brokerage account is sitting in a mix of mutual funds, some domestic equity, some international, a bond allocation. His advisor set this up 5 years ago, and to be fair, it's performed fine. No complaints there. But nobody has ever had a real conversation with David about the fact that he's sitting on $280,000 worth of a single stock. It's the company stock that he also works for. That concentration risk that most people would really find alarming if they actually saw it written down. And that position is sitting on a massive unrealized gain. If David just sells it, he's looking at significant capital gains that nobody has really planned for. Nobody's talked to David about the fact that his brokerage account, the taxable one, not the 401k, is generating dividends and capital gains distributions every single year, regardless of whether he needs the money. He's paying tax on growth that he didn't ask for and he didn't use. And nobody has talked to David about the fact that in 5 years, when he starts drawing income from multiple sources, Social Security, 401k distributions, investment income, his tax situation is going to get significantly more complex. And the portfolio he has right now was never designed for that world. David isn't in trouble, but David is leaving money on the table. Specifically, he's leaving a tax efficiency on the table. Every year, and when I introduced him to this strategy that could change that, his first reaction was, why has nobody ever mentioned this to me? That's the conversation we're having today. Real quick, if you've ever had the feeling that you're doing everything right, but something still feels like it's missing from your financial plan, hit like on this video. It helps more people find it. And if this is the kind of conversation you want more of, retirement income, tax strategy, real investment decisions, subscribe. I do this every week. Okay, let's get into it. So what exactly is a separately managed account? Here's the simplest way I know how to explain it. When you invest in a mutual fund or an ETF, you're buying a piece of a pooled investment. You own a share of a fund that owns hundreds, sometimes thousands of individual stocks and or bonds. You don't own those stocks. You own the fund, and the fund is managed for everything in it. Every decision that the fund manager makes, they're making for millions of investors all at once, including you. That's a mutual fund. It's a pre-made meal from a grocery store. It's consistent, it's convenient, and it works perfectly well for most people. A separately managed account is different. In an SMA, you own the individual securities directly, not a fund that owns them. You own them in your name, in your account, and the portfolio is built and managed specifically for you. Think of it as having a personal chef. Some high quality ingredients, but they build everything around your preference, your dietary needs, your schedule, your goals. And that's the difference between owning a fund and owning the underlying assets directly, is what unlocks something that a mutual fund simply cannot give you: control. Not control in a trading your own account kind of way. A professional manager is still making the day-to-day decisions, but the structure of your portfolio can now bend to fit your life, not the other way around. There are 3 places where this structure starts to matter in a real, measurable way, especially if you're in your 50s or 60s. Number 1, customization. In a mutual fund, you take whatever's inside. You don't get to say, I already have enough tech exposure from my company stock. Keep that sector tight. You don't get to say, I want this portfolio to generate income rather than chase growth. You don't get to say, I need to start unwinding this concentrated position without blowing up my tax bracket. In a separately managed account, you can say all of those things. Your manager can build around where you actually are in life, not where the average 57-year-old investor is supposed to be, according to some model portfolio. Number 2, tax strategy. And this is the one that makes the biggest difference for most people. Pay attention here. Here's something that most investors don't fully understand about mutual funds. When the fund sells a position at a gain, even if you didn't sell anything, you may owe capital gains taxes on it. The fund distributes those gains to all the shareholders. You get the tax bill whether you wanted the transaction or not. In a separately managed account, you own the positions. You control when gains are realized. That means your manager can do something called tax loss harvesting, selling positions that are down to offset gains elsewhere in your portfolio. They can time when gains hit your return. They can coordinate across all your accounts, and they can build a strategy around your specific tax bracket, not a generic assumption about what investors owe. For someone like David, who's in a high tax bracket, sitting on a large unrealized gain in company stock and about to start coordinating income from multiple sources, this isn't a minor optimization. This is potentially tens of thousands of dollars over a 10 to 15 year window. Okay, let's go deeper with taxes. Here's something most people never hear about. Not all dividends are taxed the same. There are 2 types: ordinary dividends and qualified dividends. Ordinary dividends, they're taxed just like your regular income. So depending on your tax bracket, that could be up to 37% federally. But qualified dividends get a much sweeter deal. They're taxed at the long-term capital gains rates, which for most people is 0, 15%, or 20%. So the dividend you get from one stock could cost you way more in taxes than the exact same payout from a different stock, just because of how it's classified. That's not a small detail. That's the kind of thing that can quietly eat into your returns year after year. Number 3, transparency. In a mutual fund, you get a summary, maybe the top 10 holdings, a prospectus that almost nobody reads. In a separately managed account, you see exactly what you own, every position, every decision, the full picture. And at this stage in your financial life, when you're trying to understand your real risk exposure, your real income sources, what your money is actually doing, that visibility matters. You can't manage what you can't see. Now, I want to be straight with you here because this isn't a pitch for separately managed accounts. This is a framework for thinking clearly about whether they apply to your situation, because they don't apply to everyone. And I'd rather tell you that now than to have you walk away thinking this is some magic solution that everyone should have. Separately managed accounts come with higher minimum investable thresholds, typically $100,000 to $250,000 or more for a single strategy. They require more planning and more coordination, but oftentimes it's actually worth it. If your situation is relatively simple, if you don't have significant taxable assets outside of retirement accounts, a well-constructed index fund or ETF portfolio may genuinely be the better tool for where you are right now. There's no shame in that. It's the right fit for a lot of people. But if this sounds like you, listen carefully. You have meaningful assets invested. We're talking hundreds of thousands of dollars or more. You have a taxable brokerage account, not just a 401k or IRA. You're in a higher tax bracket or expect to be when you start drawing retirement income. You have a concentrated position in company stock or a specific sector that you've never had a real plan to manage. You want to actually understand what you own and why. And most importantly, your current strategy was set up for convenience, not for where you're at right now. If 3 or more of those hit home, this is worth a real conversation with a qualified advisor. Because here's the thing that most people miss. I'm not promoting everybody has to have an advisor, but most people in their 50s or 60s don't need more investments. They don't need another account, another fund, another product. What most people need is a better structure. They need their money, their taxes, and their retirement timeline all pointed in the same direction, working together, not running independently. For the right person, a separately managed account can be a meaningful part of that alignment. Not because it's sophisticated, but because it's intentional. I want to stop here and ask you something. Drop it in the comments. On a scale of 1 to 10, how customized does your portfolio actually feel right now? 1 being, I have no idea what I own. 10 being, my advisor and I review this strategy every 6 months, and it's built around my exact situation. I read the majority of the comments, and your answer genuinely tells me what to cover in my next video. So leave your number. Okay, here's the most actionable part of this video, and I want you to actually write these down or screenshot the screen, because these are the 5 questions you need to bring to your next advisor meeting. If your advisor can't answer them clearly and specifically for your situation, that's important information. Question 1, Do I have enough invested for customization to actually matter? If your taxable account is under 6 figures, the math may not favor a separately managed account yet. Know your number before you have the conversation. Question 2. How big is my tax problem really? Ask your advisor to quantify what you're currently paying in taxes on your investment accounts. Capital gains, distributions, dividends, realized gains. If nobody's ever done this analysis for you, that's telling. Question 3. Do I have any concentrated positions that need a real plan? Company stock, inherited shares, long-held positions with huge unrealized gains. These need a strategy, not a vague, we'll deal with it someday, a real plan with a timeline and tax modeling. Question 4. Do I actually know and care what I own? If your honest answer is not really, that's worth examining. Especially as you get closer to drawing on these accounts for income, transparency isn't just comfort, it's risk management. And question 5, is my current strategy truly built around me or just convenient? This is the hardest one to ask, but it's the most important. The good advisor should be able to answer it specifically, not generally, specifically with your numbers. If the answer sounds like a canned response, take that seriously. Here's where I land on this. The financial tools available to people in their 50s and 60s, people who have spent decades building real wealth, are genuinely more sophisticated than what most people are using. And the gap between a portfolio that was set up conveniently and a portfolio that was built intentionally for your life, that gap tends to show up in your tax return, in your account balance, in whether your money lasts as long as you need it to. You didn't spend 30 years building what you have to end up in a one-size-fits-all plan designed for the average investor. Retirement is not the time to be generic. If this has opened your eyes, hit the like button. It helps other people in your situation find this conversation. If you want more strategy like this, subscribe. I put out real retirement content every week. Stay golden, and I'll see you in the next one.